Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com because it's about your money. I'm Ben Brayshaw, joined here with Dan Michelon and Seth Crustman. How are you guys doing today?
Doing really good. Pretty excited about today's show. Got to say, some good news in here for you.
Yeah, it's going to be fun.
I'm feeling like this show is really appropriate and relevant to today. I'm kind of excited about the idea of putting wind in the sails of the idea that, hey, everyone wants to have safe money, but they feel like they have to give up return. Safe money, better returns. That's the name of our show today, and we're gonna talk about that. We're going to talk about how to really amplify your financial overall well-being, building a foundation, creating some real appetite for a retirement plan that fits for a lot of people and that can work, and to try to build on that. A lot of people feel like when they build foundational pieces, like no one's excited about the foundation in their house. It's a cement foundation or whatever, and go down in the basement, kids. But when you actually finish out a basement and it looks really nice, like you don't think you're in a basement anymore. And I think that's the thing that people forget, is that in a foundational investment, it can do all the things you want it to do. It can accomplish the goals you want it to be, and it can actually be more than you ever expected it to be. And I think that's what I'm excited about for this show.
Yeah, it's you can always note the difference between the finished basement and the unfinished basement, right? And what that can add to a house, and how you can enjoy it and take full advantage of all the footage you got. That finished basement is, I think, what we're going to be talking about here.
Yeah, sounds good.
Well, I don't know about finished basement, unfinished basement, but you just became the Mary Poppins of financial planning to me, because I feel like there's a spoonful of sugar to help this medicine go down today.
Sounds good, Seth. Sounds good. Well, before we jump into the show and before we really get into that part of the topic, which I really want to spend some good time on that today, today we're going to step into our Money in the News. We've got some great articles for you. Here we go, Money in the News.
All right, first up, we got an article here from Jed Graham. CPI inflation rate sizzles in June. Dow Jones slips on the Fed outlook. So I think, inflation is something that you've heard us speak to many times here in the show, particularly lately. And it's the ongoing topic of conversation in the financial news, wherever you tune in, whatever station you watch, whatever publication you read. It's all about inflation, right? And June, again, was another record, official 40-year high at 9.1%. Which is truly running red hot right now.
Yeah, I think as we look at CPI, the Consumer Price Index, and kind of the everyday items that people are buying, this is your groceries, this is your fuel, your utilities. These are the basic costs. To think that it rose 1.3% in a month, and it's up over 9% since last year. I don't even think these numbers do, honestly. They're reading them it's actually hard to read because they're so high. But I actually think it's higher legitimately in the eyes of everyone out there spending. I don't think these numbers do justice to the inflation we've seen.
Yeah, I'm not in the housing market, thankfully. So, for me, it's gas and groceries, and 9.1 feels low in those two segments, that's for sure.
Yeah, it was actually pretty hard to believe that there was a bit of a pullback in energy and gas mid to late June. I didn't notice that. Every time I'm going to the pump, it's it's $100 and I'm still not getting totally full. It's like I've got one of those triggers on my card or something, or the limitation on the pump, where it's like that's all I get, and I have to repump if I want a full tank, and I've just given up. I'm like, whatever. I'll be back in 2 days.
Yeah, no, I know exactly what you mean. Some of the the gas stations haven't increased that automatic shutoff limit because everyone's overspending on gasoline. But when it comes to what we spend and what's going on in this marketplace, I think it's hard for people to swallow, all that's going on here in the expenses, especially when you feel like, hey, my portfolio is going down, the market's declining. Those are interesting things to address. I think in looking at some of the numbers, and this article does a really good job. There's some stuff that's pretty specific about certain areas, but it does do some really good jobs to some home hitting items like used cars. I thought that was interesting. They said used cars rose 1.6% on 1 month, and it's up 7.1% from a year ago. Now, I'll tell you, that may be true for some cars, but I know that we sold a used car for ridiculously more than it was worth. So, I mean, it's just that was the going market rate. Guy said, I'll pay you this much. I was like, okay. So I don't necessarily know that these numbers, again, justify it. But the one that's really, really scary, and again, not quite accurate either, energy prices rose 7.5% in a month. And Seth, as you said, hey, gas prices did drop in June. I did notice it at the pump.
Yeah.
I did see it drop. And I'm not sure if that was because Biden was selling oil to China or not, but that's another story. But energy increased 41.6% from a year ago. I mean, we all know that it's over. It's over 100%. So they have to be, the number that they're actually quoting has to include electricity and other forms. It's got to be all means of energy, because this is low too.
Yeah, I know that's something that we just started exploring. My wife saw on Facebook, that she's part of a local town page here in Bedford, and everybody's running from the primary electricity provider to some other company I'd never heard of, and they're touting the discounts you get. So I think she's considering making the move. I'm a little nervous how well that's maintained come winter and all the other issues that come around with that. But
there's this huge potential increase in electricity in New Hampshire that they're talking about, which everyone's talking about. It's crazy. So, next up on our list, Seth, you want to take the next one here, bud?
Sure, I'd love to. So, Patrick Villanova, thank you very much for bringing us the article. How a new Supreme Court decision could help you save for retirement. Interesting how this has been a story that started out in Northwestern, college in Northwestern, and it goes back into pre-2020, mid 2016-17, where they brought a case from Hughes versus Northwestern, remanding the case back to an appellate court for reconsideration. I didn't even give that justice. Basically, they brought it to the state court. It got shot down. And then it came into the Supreme Court, where they advanced it and said, we're going to support this. And the premise here was that they had over 400 options for their retirement plan, which is remarkable. Just that in and of itself is like, holy cow, that's a lot for people to choose from. But what they felt like wasn't happening is this fiduciary duty to really monitor those investments. Some of them really high priced for what they were getting, and that's, in any other market, I guess you could consider that consumer gouging. If you're able to get something off the shelf, which is equal or better for a better price over here, and they just weren't monitoring that. And that's part of their duty, is what they're calling it from this, from the court steps, is that they need to be paying a better attention and doing a better job on these plans. And, frankly, the 400 is, folks, wow, a lot. Good luck choosing your best plan there.
I think that's just the overwhelming piece. I think I honestly, when you read this, it's reinterpreting fiduciary, in my perspective of the article. Like fiduciary is not only, providing all the advice in the best interest of the client, but you also need to know how much advice and options you should provide, right? Because, at some point in time, we all agree, hey, 400 is too many, but when does a plan have too few?
Yeah, there's a real lack of clarity in what the expectation ultimately is going to be here. Some things are pretty simple and you can see them kind of in black and white.
And some things are relevant. I really think they're good, but go ahead.
Yeah, no, the things like and this is kind of industry speak, but they weren't offering institutional share classes, which just means amongst the funds that were available to choose from, there was different price structures available to them that they weren't taking advantage of, the cheapest to the consumer.
Right.
So they could have done some relatively simple things to offer very similar funds at significantly lower cost, and they just weren't taking that opportunity. So that's pretty clear cut. But
we wanted to make sure that the whatever you were buying was the least expensive fixed cost that you could provide, because theoretically some of the other investment options, if you left them there long enough, would turn out to be cheaper if you had purchased them. But they're not, most people, and the truth be told that, John Hancock did that study years and years ago that said 86% of people never rebalance or reallocate their retirement plan. So the likelihood that the other fee structure was cheaper was probably not even taken into account, but whatever.
What's clear, when you end up with 400 options at varying price structures, nobody's monitoring this thing. Right?
Yeah.
There isn't anybody with any knowledge who is helping guide the selection process here, which that's the part of the ruling I think can get on board with. But the ambiguity for the professional, for the advisor, like we do, is, what's the right number?
90% of
10
people,
too many?
90% of people that are investing in these in a 401k is getting zero advice anyways, or zero good advice, I would say. And they're taking them and the person they're talking to on the 800 number are taking a dart to a dartboard and covering their eyes and saying, pick one.
They jump into the target date funds, and we've done shows on that.
Yeah.
So,
there are also the third-party fiduciaries, which are almost a customary solve to this in any 401k that's being offered or is there available for people today, that it just doesn't seem like that was a consideration. And then I just think if somebody were to come in here and say to us, hey, what do you guys got for financial planning? And we were to offer them everything that we have here and say, take your pick, how well would that go or work out? That's a self-service model that probably, if you're looking at all the options that we have here at Brayshaw Financial Group, it's not a fiduciary standpoint. That's not what we do. That's a different model, and that's where they're trying to bring it back.
Yeah, we're all fiduciaries here on this show, and all our partners are. I think what's interesting in this space is that just because you are a fiduciary and you're supposed to take someone's best interest at heart doesn't mean somebody is. Right. And so these plans are supposed to have a fiduciary model, and clearly they're just slapping a sticker on this thing. And I think that's the sad part. And I think that's what's being brought about, which is probably why the Supreme Court said, let's embrace this thing and get some activity. And I think if you create a little bit of headwind, all of a sudden these companies start jumping and they say, yeah, we should be doing a better job. And I think that's good. I thought one part of the article that was interesting was we were talking about this last week. Because a lot of people say, hey, I can take 5% out of my portfolio and retire. But most of these 401ks are dictating, we talked about, what future income might be out of a 401k, and they're showing your current value. But they're talking here about the rule of thumb has changed minimum to a 4% distribution rate. And I think that's really interesting because it used to be a kind of almost 5% was a standard rule of thumb. And I think Monte Carlo's down to low threes if you're early 60s. 3%, 3.2 or something. And this is saying, the rule has been moved to at least 4% by these things to enhance a fiduciary perspective as well on something more appropriate in the distribution range. But I don't think they want to make it that low.
Yeah, and I think the message here for everybody listening is simply that if you start getting correspondence around your 401k or you're seeing plan options change and projected income figures that don't necessarily add up for you and it's creating any kind of concern, just take that opportunity to come visit with us. Give us a call. You can send your information through the info at Your Money on Tap website, and we'd be happy to sit with you and just run through those options, compare costs, give you probably more relevant projections on what income might look like in retirement. And if there's some reallocations that would be in your interest, we can help you with that as well.
Yeah, that number is 855-226-8551. Thanks, Dan, for bringing that right to the table. And the email address is info@yourmoneyontap.com. We'd love to hear from you. Call us, 855-226-8551. Our last article for today is who is this by? Greg Norman. Thanks, Greg. Fox Business electric car survey finds this is the biggest reason preventing people from buying them. Preventing people from buying electric cars? Goodness gracious, what's going on here? Well, this article does a really good job, I think, of explaining a number of different perspectives of why EV cars don't work for certain people. And one of them is just like, where would they be able to charge all these cars in the city? I mean, people in the city are like, if I have a car, I got to have a place to park it for 12 hours or 20 hours to charge the thing, and I don't have a place to do that. And there's not enough charging stations for everyone to charge their car every night.
Yeah, Biden, I know he's proposed, building 500,000 of these stations here. But as we speak, not really happening. And that is cited as
500,000's a drop in the bucket.
Yeah, I mean, that's not enough. And they're not even close to that at this point. But the leading factor in which why people choose to stick with the gas automobile, 61%, they speak to the charging logistics. Where to get it charged?
Where to get it charged? I mean, I'm thinking of it like in New York City, you have like extension cords hanging from everyone's window. How do you do that? It's just very, very interesting. It says that they talk about, well, there's a couple of things that are pretty interesting here, but they said that 36% of people are seriously considering that an EV only vehicle is part of their next purchase idea. When 8,000 people were evaluated in a poll, but there's just not enough electricity. They go into the fact that there's not enough grid space. Like they're talking about how when you actually get into the idea, and I was reading through, I don't know if you guys did this, but I read through all the comments that people were making, and they were talking about, I mean, everybody under the sun, they talk about the batteries, the fact that you can't separate some of the chemicals and the materials and recycle them. But what they get into is interesting is that there's a whole problem with the electric grid and the demand of the number of people that would need to charge their vehicles. Like if everybody had EV cars, our grid could not possibly handle just the flow of the electricity.
I didn't realize that. No, I didn't see that, but that's a scary notion because clearly this is the trend. I mean, 20 years from now, we'll be there, right?
A current car, a current gas-run car, you go to the gas station, you pump gas in it, you turn the thing on, you drive somewhere, you pump more gas in it, you drive again. I mean, that's how it works. It never touches the grid. But if you think about the amount of electricity flowing through that grid, even if it's made from solar or whatever, they said the demand on the grids, there's not enough grid out there to handle the amount of people, like not even like everybody, just like a large increase. The demand is overwhelming.
Yeah, one of the this is not a headline from this article, but something else that just popped up was from CNET. Real cost of electric car ownership is one of my friends insisted on trading in their Porsche Cayenne for a Cayenne hybrid. Even after I penciled it out, that would take him 111 years to break even. So maybe it's not, the Porsche Cayenne's fault. I'm sure there's other ones out there that would make more sense, but still, that's one of those factors that people may want to take or maybe they are taking a look at is this a convenience factor for me to have to go to these electric charging stations and maybe deal with the maintenance costs and everything else? At what point is there a break even?
Well, and we just bought a hybrid vehicle, my wife and I, and we got there's a tax credit involved in it, and so that's helpful and so forth. And we figured we would break even on the gas vehicle over about 14 months. Well, that's what I am. I'm a financial planner, so hey, let me pull out a calculator. Let me figure out how this is going to work. How many miles do we drive? So 14 months we break even with a regular car, and then on top of it, that's the potential savings down the road. But I got to tell you, I'm really curious. We just got it like a month ago. I'm very curious how my electric bill is going to move on this thing because I might never plug it in if it's too expensive, right?
You're charging at home.
Yeah. So that's been. So, anyways, there's a lot to this. I don't think I would ever go electric only because there's just not enough infrastructure. I want the ability to be able to pump some gas and go if I need to go. I don't want to be because some of these vehicles, it takes a really long time to charge them. Tesla's significantly better, but a lot of these companies aren't. So, well, that's going to do it for us in Money in the News. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Stick with us. We're going to talk about safe money and better returns. This is going to be a good show, and if you're scared about what's going on, this is the one you want to hear. We will be right back.
Hey folks, Seth Cressman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. It's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. If you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon and Seth Cressman. If you're just joining us, we're talking about safe money, better returns. Lots of people have questions about how to make more money, and they're scared about the market. Well, if you are, we're all partners and planners at Brayshaw Financial, and you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We're also on, goodness gracious, I think every social media out there. I mean, that's just the way it goes. So look us up in whatever one you use. But as we talk about the market and we talk about all the kind of upheaval that's occurred for a lot of people, and there's people out there that we talk to have lost a lot of money. I mean, the market's down between 25 and 30% on any given day and year to date. And people are very nervous. And we've been doing this kind of conversation about annuities, and we talked about safer money and how to advance returns. And people are selling their assets because they're scared. They got retirement coming right around the corner. And people are looking for solutions. And if you're one of those, you're not alone. It's a common theme. But in the idea of safe money, better returns, there's kind of this general conversation, guys, that, if I look at an annuity, I'm giving up. I'm giving up something. Like I'm feeling like I haven't figured out the market. I'm resigning myself to an annuity for, various factors. And I think we need to talk through this and figure out if people really are giving anything up. What do you guys think?
I think that's, probably the wrong perspective on it. I mean, there are some, like anything else, there's pros and cons, and we'll talk about that. I mean, one of the things you may be giving up is a little bit of liquidity. But when you consider annuities like we do as a foundational piece of a portfolio, that foundation gets cast for the long term. No one pours cement for a 2-year foundation, right? When you dig the hole, you pour the cement, it's supposed to last. It's supposed to be there forever. And that's the way we use it as a tool inside of a portfolio. So it isn't for your kind of ins and outs of the market as buying a stock might be or a particular fund. This is the base that you build off of.
I love the analogy there of the building your house and creating the foundation. And, not a whole lot of people, when they're putting their dreams together of what this home's looking, they're designing the house. How many people sit there and pay attention to, I really want to design this foundation for to last. People don't think about that. They're thinking about, do I want a 1-story or a 2-story or, a cottage or a farmhouse? The dream is this building that everybody, like, you live in and you see and you experience. Now, if you take a look at the cost of that foundation, because you're going to have one, right? That's where people, this is actually what people in their minds are doing right now, is they're saying, wait a second, I'm not going to have a 5-bedroom with a bonus and everything else that I've been dreaming of. You're telling me that I can only have a 4-bedroom because the cost of this foundation over here that's going to support the house is X amount of dollars. The consideration there. To us, I mean, it's silly, right? We wouldn't think that way, but that is the relationship that is happening right now with people and the marketplace and the retirement, this idea of retirement, everything being put into something that's volatile. Maybe, like we're experiencing now, 25 or 30% less than it was 6 months ago. Now what? How are you going to build this house? How are you going to retire the way that you want to retire? Because it's not there.
Well, if that was your foundation, your 8-foot basement just turned into like 6 feet. It might be 5.5 and you can't walk through it. So
a slab.
Yeah, exactly. So that's very, very good. And I think one of the things that I think is that people, intrinsically know they need a foundation. I mean, nobody out there saying, hey, caution to the well. There's probably a few out there. We've met them, but caution to the wind. All my eggs in one basket. It's all going in the S&P 500. Every penny, I'm going to keep just enough in my checking and savings account to pay my next week's bills. I'm going to invest everything, watch it tank, and that's my foundation. And most people are not doing that. But what people do consider a foundation, or what people are using as foundations, not that they can't be foundations. But do you want to build a really strong foundation that has vibrance, or do you want to build something skinny? Like, do you want your basement walls to be only 2 inches thick, or do you want it to be 6 inches thick? Like, those are what people are really trying to figure out. And I would actually say that a lot of people are losing return. Like, we talk about safe money, better returns. And I think people are giving up a monumental amount of returns by the amount of money they leave in the banks. Now, we've thought that and talk about that for years. But today, with inflation, right, at 9.1%, that money in the bank is going backwards astronomically. It's like a race car going in reverse. I mean, it's just not accomplishing the lap. What really needs to happen is people need to realize there's other places to put money that create foundations that actually have stronger, greater, better returns that will help mitigate their overall average. So in my example is let's say somebody has the S&P 500 and they're averaging 10% a year and so forth, but then they say we need half our money in the bank so we have a good foundation. Well, that sounds really well and good, but the truth is like that bank's making nothing. So what's your average return when half your money's sitting in the bank making 0 and half's making 10%? Well, your return's 5. Right. And that's really the problem, is because people create, foundations that are only a couple inches thick that are actually dragging the house down. It's still a failure in the financial planning process. And I think what I want to talk with you guys about is our first point today is safer principal.
Yeah. And that's one of the primary benefits of annuities. And, above and beyond all else, you have a guarantee from an insurance company, a well-funded insurance company. And when you're choosing annuities, ratings matter, and that's something we can get into as we sit with you. But your principal is 100% protected. So you can rest easy knowing that whatever it is that you invest inside of an annuity, you will get at least that back.
Yeah, and we're talking like, hey, pure fixed annuity, no market exposure. We're talking boom, boom, boom. Like this is just a box. Like, because people go beyond the checking and savings. They might say, hey, well, Ben, I'm using CDs and I'm making 1.5%, 2%. What do you think about that?
Well, still not keeping up with inflation, so it's
and still not keeping up with annuities on the fixed space.
Correct.
One of the things around the protection piece, and I know this is okay. I know I'm going to reach a little bit here, guys, but stay with me.
Reach away, Seth. Reach away.
Okay. Oh, thank you. So we're talking about principal and that principal protection, or that guarantee of that principal, right? And what is it that means to people? Usually it's meaning their estate. It's meaning their future buying capacity, or their ability to outlive their assets. So a continuation of income while they continue to live for the rest of their life. Those are two very meaningful places. But there's also, and this again, it comes back to the first one, which is that estate, which is that guarantee of principal, where in an annuity, not always the case, but in a lot of the annuities in the annuity world, there can be some protections or some advantages to that death benefit. Very much just like a life insurance policy, that principal could be provided or protected for the estate, the heirs. And in that process of being inside of an annuity, it also offers another feature, which is bypassing probate. Okay? So those of us that deal in this world regularly, that is a gift that is tremendous for a lot of people, as they are working with assets after their passing.
Yeah, I think, as we get into, more of these things, I think, there's just so many options. There's so many avenues to what you can do with an annuity. And the opportunities are kind of almost endless if you're getting into the estate planning, which I know you're talking about. But as I'm kind of like thinking through this, and I'm thinking about the safe money, better returns, and we're talking about how to amplify and increase your average return. And using the example I was talking about earlier, right? The savings account's making 0 and the market value is making 10. And let's say that's the world you're living in, you're averaging out 5, right? If all of a sudden your fixed annuity is making 5, and I know there's no fixed annuities guaranteeing 5 out there today, but I'm just using it as an example for easy math, and your market value is 10, well, now your average is 7.5%. And the whole point of just bringing out better returns in your portfolio is not giving up, because people don't realize they've already given up when they've amplified their holdings in the bank. I was just talking to a gentleman yesterday. He's like, you know what, I knew we had chatted about it a little while ago. I was like, listen, I know you got some funds and we're going to invest those and so forth. Yes. I'm sending you the check. Check doesn't arrive. Dan, you were in my office. I was like, hey, bud. I was like, haven't gotten that check yet. I mean, this is a really good opportunity, I think, to take some specific positions and investments. He's like, you're right. I was just nervous, and I know you've done good by me. So check's on its way. I talked to him this morning. He's already mailed it out. I want to make sure we knew it was coming. But his fear, like everyone else, is like, I'm just going to hoard the money in the bank because that's really, really good. That is the worst thinking out there. You need to understand, as you pointed out, Dan, how much liquidity do you need? Have someone articulate that for you financially. Like, you might be able to verbalize it, but someone needs to put it into a financial form. And then you need to start amplifying every dollar within your risk tolerance across the board so you can get those better returns.
I think there's some it's a psychological thing, and I grew up with this too. I come from a family of savers, not so much investors, right? So, if that number's in your bank book, right, and you're looking at it, you just know it's there.
Oh, you feel good. It feels good.
It feels really safe. You just know you got it, right?
Ride that off into the sunset, folks.
But the reality of it is that, you're just taking the money from one pocket and moving it to the other. It is still there for you. It is still guaranteed. You still have access to it. It may be limited, but there is still access to it at all times. And if you needed to take some of it back to cover a cost, you can do that. We just need to have that conversation around your point, Ben, from a liquidity perspective. How much might you need for that, whatever occurrences that you've been saving for? What's the number?
Right.
And let's work with the rest and get you some actual relevant returns associated with it. Because a long time ago, I heard something, as I kind of was beginning my career in finance, this was really eye-opening for me. As I told you, I come from a family of savers, and someone just told me, listen, you can't save your way to wealth. You can't do it. You have to be invested.
Can't save your way to wealth. I love that. You're listening to Money on Tap. You can reach us at 855-226-8551. We're talking about safe money, better returns here today. And we just went through kind of the idea of safer principle. But I think we can take this another level into our next point, which is safer growth. Safer growth. I think when people say, hey, what do you mean by safer growth? In the annuity world, there's a lot of opportunities to get exposure to either participation, to participate in market returns, but not necessarily be invested in the market. There's ways to invest directly in the market and have underlying guarantees that facilitate principal protection. I know a product I used for a client who had a death benefit guarantee of the principal if the market tanked. And that's what they wanted. And they wanted the opportunity for some upside. There's lots of different what we call riders that create opportunities for safer growth. Let's chat about that, guys.
Yeah, I think one of the primary things I think of when we talk about safer growth is in the fixed index annuity world. And that would be something that for people who have held them, especially over these last few years, you're probably really appreciating right now. And what that simply means is that over the course of your policy year, right, so everybody opens a contract on a day and, fast forward 12 months from that exact date. Over the course of that policy year, if there was a gain realized inside of your contract, which would be indexed to a major market index, that gain gets locked in at the end of the term. So going forward into that second year, even if the market absolutely tanks like we're experiencing right now, everything you made in year one is guaranteed, locked in, and protected, and will be there for you.
And it doesn't go down.
It does not go down.
There you go.
Right. So we've seen this whole pandemic swing, right? Down 30%, up 50%, back down 30%. It's been truly a roller coaster. I mean, literally looks like a roller coaster. And if you had an annual reset product, you might not have realized all of the upside on the ride up, but those gains, some significant portion of them would be locked in, and you'd still be holding them. And why the market's tanking in front of us, you're experiencing none of that loss.
Yeah, I think that's really, and I mean, the idea of locking, getting that growth, so safer growth, and then locking that growth in, safer principal. Yet that's your new principal. It's locked in.
Yeah.
I mean, and that I think really brings those two together in the indexed annuity world. And we talk about index because they give you a participation of what the index does. Like money's not in the index, but they calculate what return you're potentially eligible for in that year. I think I'm going to pass this over to Seth, but if we start going into like the variable annuity space where we're starting to talk about, the market, like getting deep into the market, like I want to buy mutual fund sub-accounts. I want to get invested in things that, really have market upside. I don't want to be limited. Like I'm afraid of giving something up. What do you think about that, Seth? Are you giving something up?
Gosh, I really wanted to go back into the safe money thing. Would you mind if I did that for just a second? Okay. Yeah. So in terms of the marketplace, because this is the comparison that we get most of the time. It's like, well, matter of fact, actually, we get the bank comparison most of the time. True, right? With the yields on CDs or what the bank is doing, because we're talking about this safer growth comparison. But a lot of people like to go into the market and say, well, I'm going to go into a bond portfolio, meaning they want to have some kind of safety, right, with their assets that they have in the market. Or how many people right now have heard the commercial, hey, you need to diversify your portfolio and buy gold. Okay, well, that's a commodity, and that is an asset that is usually used to hedge the market. When the market's coming down, gold will usually, do the opposite, right? That's a hedge or stabilize a portfolio. And I just wanted to take a quick peek here over the last month where, everybody's been looking at this marketplace and saying, holy cow, what are we going to do? If you take a look at either one of those assets right now, you're talking about roughly a 20% decline in either one of those assets, bond 10-year, gold, whatever you want to take a look at in either one of those. They are experiencing the same thing that market is, right? And that is not a comparison to your CD. That is not a comparison to the bank, right? But that is a marketplace comparison. And comparing that in terms of the opportunities that an index annuity might have, right, where it's being tied to something like the S&P 500 or, the Russell, whichever. There's just different indexes, right, that these can get kind of tied to and have different ways that they they work within a marketplace for growth. The benefit with one of these is that you have the opportunity within that marketplace to have the growth when, we have a year or two, whatever, marketplace that we've had historically over the last, 10, 20 years has been tremendous. But you can have that marketplace participation going up, the growth of it, but you have the downside protection where they will not lose money, right? There's a floor where that protection is there. And so that's the peace of mind that I think of in terms of the annuity world where, people don't want to give up, right? Throw in the towel. We were talking about throwing the towel, give up. You don't necessarily have to associate giving up with an annuity. There's so many different ways to allow people to have that participation in the market without that, the downside of what the market, give it bonds, give it gold, give it whatever the market might be working out to.
I did a lot of seminars a long, long time ago, and I used to talk about, the idea of the Golden Gate Bridge and how when the Golden Gate Bridge was built, when they built it in 4 sections. And when they built the first of the 4 sections, there was like 11 people who fell and died during the construction of that. And there was news articles saying, hey, listen, this bridge is too big to be built. Golden Gate Bridge, it was going to be the largest bridge in the world at the time, and we shouldn't be doing this. And there was a contractual obligation to finish the bridge. And so the company started figuring out, like, listen, what do we do to allow this thing to work? They were over budget on the first section. They had these deaths. They had the press, the media, everything. So because of the contractual obligation, they built a net under the second portion of the bridge. And when they built the net, what they never expected, wonderful news, no one died. Anybody who fell was caught by the net. But what they never expected was that they built the second, third, and fourth sections with that net, even though the cost of that net put them astronomically over budget projected-wise. People felt so secure with the net that they built the second, third, and fourth sections in record time. And that record time actually made them make more money on the entire project than they ever expected to make. And I think the wonderful principle I like about that illustrative story is that when you have a net under some of your investments, it allows you to act more freely to how you feel like you should invest, right? I mean, like at the end of the day, you're not leaving as much money in the bank, maybe making 0%. You're not buying bonds that are now going underwater because the interest rates are rising. If you don't understand that, you can go back to one of our bond shows. But hey, if you own bonds, you're realizing, hey, they're devaluing quickly, and I'm not sure what to do. There's having a net underneath your portfolio really gives you the ability to act and invest the way you should. So even though some of the variable annuity space, like we talked about the fixed index annuity space, we talked about the fixed space, those can have zero fees. Some variable annuities can have zero fees, and some variable annuities can have high fees. And there's objections to all of these scenarios, right? So finding something that fits you best is really important. But what I have found is that for the people who are so super conservative, who have like all their money in bonds or massive amounts of bonds, that when they actually move to the annuity space, out of the bond space, they found themselves investing more like a normal average investor, making better returns, even with the additional fees, even with nominal fees. I mean, it just gave them the freedom to do what they really knew they should be doing investment-wise. I thought that was an interesting scenario because when it comes to throwing in the towel, Seth, as you talk about, like, am I throwing in the towel by buying an annuity? The truth is that you're doing exactly the opposite. You're hopping on the mat. You're ready to fight. That's how I look at it. It's actually an empowering event. Now, we talk about stocks. We talk about bonds. We talk about these things all the time. We manage a ton of money in straight-up market investments, fully exposed. We've done exceptionally well over this market cycle. And, if that's an area that you're looking at investing, yeah, come talk to us. But there is a place for that retiree that's looking for the net, who says, I know the market's going to recover. I know I'm going to be okay, but I need to solve some other problems. And that's where we get to safer income. Because when you start looking at that safer income scenario, if you're taking money out of a downward moving market portfolio, trust me, your income's going down. Your income is going to be dropping because you're going to be scared about taking too much out because of what we call compounded loss. The annuity solves the problem to allow you to take out a fixed amount every month, every year, however you want that distribution, without it changing, irrelevant of the stock market, guaranteed forever. Like check the box, it's done. And you can do that mentally. Like you should be able to take that income out. But invariably, most people reduce their income and they live with less because they're so scared that they might make a mistake and take too much out. Like right now, market's down. I shouldn't touch my portfolio. That's the fear you're living in. An annuity can actually ramp you back up to where you were because their distribution rates are better than Monte Carlo right now. And that's, I think, the kind of the norm.
Yeah, and it just gives you the freedom to live life the way you want to, right? So for people who have just retired, these are supposed to be some of those best times, right? This is when you don't have the obligations at work, you're free to travel, free to do things. But then when you watch your portfolio drop 30%, you probably postpone a lot of those plans, right?
All of them,
right? And then the life goes on, and when you feel when the market does finally rebound, and we all know it will, maybe that window to travel has kind of passed you by. So this will give you, I think, that opportunity to carve out just a guaranteed income that fits your needs, that's that foundational piece that covers the costs that you must have be paid. And then for whatever else is left over in your investments, that's where you can live on and take a little bit more risk.
It's really nice to be able to just live your life without the fear or the concern of circumstances dictating to you the terms, right? I mean, how nice is it when people weren't traveling I don't know, if you had a private jet, whatever you have, that you're able to travel with freedom without even having really a concern about what the rest of the world is dealing with in this pandemic. And just one quick thing on the income, on the Monte Carlo, right? We talk about a 4% income, and I'm going to bring this right back to you guys after this quick break. You're going to hear a little bit more from us at Money on Tap. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap. We are talking about, safer returns and a whole bunch of other stuff here. Can't wait to talk to you more. We'll see you soon.
Call us today at 855-226-8551 and get your free consultation with Ben Brayshaw or Seth Krussman or any one of our partners and find out what's going on in your plan, your estate plan, your financial plan, or what you're planning at all, if nothing. Get it fixed, get it right, get it done today. Give us a call at 855-226-8551.
Thank you for joining us for Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's show with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, we have gotten into a discussion here about really building your retirement, a safer principle, safer growth. We're talking about safer income. And the illustration that I was just talking about was just having the freedom to live your life without even having to worry about, is your income going down? And just some quick math for you here. We talked about the Monte Carlo, which is a battery of tests on, different scenarios. If this happens, what's the likelihood or the probability of you being successful with whatever you've built up and whatever you have under the hood of your retirement plan. And that 4% distribution or that 4% income off of the asset is kind of that go-to number in this scenario. Used to be 5. They brought it down to, 4. But this is what that would look like. If you have that nest egg that you're in the market with and you're thinking, hey, I've got this thing all dialed in. I've got all my, mutual funds, ETFs and stocks or whatever you have out there in the market. In the market, you have $1 million and you're taking 4% income off of that. Well, that's $40,000. And that's what you're anticipating being able to use. Well, in a market like we have now, if you're down to $750,000, you've gone down to $30,000. You don't get to continue if you want to maintain and keep that asset and grow that asset and take income off of it. You don't get to continue to take the same amount of money you did, 6 months ago. It just doesn't work that way. And that's what we're talking about is modifying your life to fit or having to modify your life to fit whatever you can with what you have and how the annuity can provide a totally different stream of income, a different kind of income that you don't have to depend on the market always being here today, what it was yesterday.
Dan had mentioned, we were chatting before the show, and I think this is a really good point. A lot of people don't have pensions. They don't have that foundational income. So we talked about foundational assets, but foundational income, I think this is where you kill two birds with one stone, right? I mean, you've got this guaranteed lifetime income. It's not changing, right? You can do it joint for you and your wife. You can do it for joint for you and your husband. You can, however you want to do this, it's good to go. Like however you want to structure it. And yes, you can usually get more than any statistical analysis out there from the insurance companies because the insurance companies can wait. Your life is defined by whatever day is the last day you walk on this earth. It's defined. But the insurance company have the ability to hedge the market over 100 years. 50 years past your retirement, whatever it is, that story, and that's safer income. So we talked about safer principles, safer growth, safer income. I think that's what people miss is, if you're putting a ton of money into annuities, buyer beware. But if you're talking about foundational elements, like when you talk about a basement in New Hampshire, right, we talk about a full basement. Like you can walk down there, you have your game room down, whatever you're going to use it for, right? But at the end of the day, you don't see the basement when you look at the house, right? You don't even really see it. I mean, some people have a walkout, but you really see the 1 or 2 or 3 floors that you have above. You see the roof line. You see the aesthetics, but But the ability to have that basement and the surety and the safety of that's that income coming through every day. And I think a lot of people have realized that this up market's not going to happen forever. Oh, I missed it. And you should have bought an annuity last year, right? It would have been that much better. But there will be another rise. Will that rise be next year or 5 years from now or whatever? But don't delay on the opportunity to build a better return in your portfolio, to invest the way you want, get that money out of the zero return bank, start fighting inflation back, but you don't need to be aggressive where you're being vulnerable.
Just as an example, thinking about, kind of moving back to the safer growth conversation, safer principle, it just came to mind. I mean, we have an opportunity. We've got one particular annuity that we've been looking good and hard at that. Listen, if you've been in a CD for more than 5 years or more, which a lot of people have, at a 0.5% rate or 1%, we can literally give you the opportunity to guarantee 3% over those 5 years or the index, whichever one of those two is better. And there's a provision built into the product that says, too, unlike your CD, anytime you want your money back, you can take it.
Yeah.
So, I mean, that's like being at the bank and in the market and liquid all at once.
Yeah. I think these are the things that people don't know because they don't work with financial planners that are independent, that have the exposure and the opportunity to really look at like that, most people don't even know about that product. That's, you came to the table. It's like brand new. We're constantly pushing the envelope to try to find the best scenario for people to amplify their potential future because it's all about accomplishing your goals. Like getting to retirement. It's what is the biggest misnomer is everyone says, the market went down. I can go back to work. I can get a part-time job. What do you do when you're 80 and you're running out of money because you screwed up? You can't. That's a fallacy. People convince themselves all the time, I can mitigate loss. I can deal with that. Well, maybe the first couple of years, yeah. But statistically, a successful retirement is based on the first 5 years of return in a standard market portfolio. You can get rid of all of those statistics just by creating solid foundations in your portfolio. And that's not throwing in the towel. That's making a full retirement. There's no ifs, ands, or buts. The story's over.
We're not advocating anybody quit the market, right? This notion of throwing in the towel, I can't do it. I'm giving up on it. We're not sitting here telling you take 100% of what you got and dump it into an annuity today.
No,
that is absolutely not it. That is not it. So everybody still needs some market exposure, presuming you can tolerate it and, you can sleep at night knowing you're invested. But if you have that personality and you've been in the market before, there's no reason to exit entirely. That's not what we're talking about.
And I think that's generally obvious from our conversation, but I'm glad you clarified that. There is no perfect number of how much you should have in a foundation, right? Because your risk tolerance may vary based on how much risk you want to take. So you may say, hey, listen, I have all my money in the bank, all of it. I'm the saver, Dan. Maybe you step a little bit into an annuity and you leave some at the bank. Like that might be as far as you can get, and that's okay. We're all about just getting safe money and better returns and trying to get you, because honestly, by buying an annuity, you're not throwing in the towel. You're really amplifying your opportunity for returns with the safe money that you're trying to already do. You're already trying to mitigate that. And for the person who doesn't have a foundation, you're not throwing in the towel too, because you're actually protecting the assets you have in the market by knowing that you don't have to cramp those when the market's down 25 or 30% because you need income.
Yeah, it allows you to stay invested the way you were, right? If you're fully in the market and you've just experienced what we've experienced.
You want to sell Apple at $148 a share when it's down from $200?
The things you love, things that you have every reason to believe are going to appreciate again, you still run into the hills. You're still potentially getting scared out of it by doing this. If you can pare down that portfolio, move a percentage into annuities that have the guarantees that we're talking about, right? Not just any annuity, but the ones that have specifically the guarantees we're pointing at, that allows you to stay invested with the rest of it.
Well, you've listened to Money on Tap. We've really enjoyed you joining us this week. You're listening to Ben Brayshaw, Dan Mickelon, and Seth Crossman. We are all planners and partners at Brayshaw Financial, and we really believe that safe money and better returns exist for you. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com. Send us some emails. Let us know what you want to hear. We have some special gifts for people who get a show topic chosen. So we'd love to hear from you, and we'd like to hear what people are interested in. Stick with us. We'll be back next week. Have a good one.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.